Hey everybody, Brian Foote here. Wanted to talk to you about a question that I saw out on the internet today. Will value investing come back? All right, so clearly that's top of mind for a lot of people, and I wanted to give my own opinion of it. Clearly, you can point to the track record of Warren Buffett and others who have the value moniker attached to them and their track records and say, does it really ever go away? Value investing is buying assets, generally in the stock market, at a discount to what they are worth, full stop, for many people, right? So there's two things right there where you want to think about what fair value means, and obviously a discount is just a percentage to that, right? There's people out there, and I'd argue with them, that say that the market is efficient, and highly efficient, right? The efficient market hypothesis, and they talk about the strong form of it, that at any given moment, the price of a stock reflects every single thing that's known about it. Uh, it's somewhat tautology, right? Because a stock that was trading at $30 and now is trading at 10 could actually be just a function of an overreaction to that some bad news or something that that maybe the fair value is truly $30, and the temporary disconnect between the the emotions of the holders who ultimately sold and the buyers who lacked sufficient guts or sufficient analysis to understand that they were being sold a great bargain. It flies in the face of the efficient market hypothesis. The other thing is, again, I point to the track records of active managers such as Buffett, such as Charlie Munger, such as the super investors of Graham and Doddsville, and even modern practitioners like David Einhorn and Bill Ackman and Lee Cooperman and others that you can look at, Carl Icahn, all of which have had a deep value type of or activist type of name attached to their track records, and all of whom have generated supersized returns. So back to the question at hand: what is what is stopping value from outperforming growth? And what definitions should be applied? Um, you know, Buffett has said value and growth are joined at the hip. So when you're buying a business, you're assessing the growth characteristics of that business. A lot of people look at value investors and say, "Oh, those are the people who buy broken down book value discounts, or what Buffett termed cigar butts." A cigar butt meaning a business that, like a cigar butt, has been left on the ground, and like a soon to be extinguished cigar butt, maybe has one or two more puffs in it. Very colorful language, but that's what he was comparing that style of investing to, right? Buying deep book value discounts. A couple things. One is that those opportunities don't really exist the way they did back in Ben Graham's time or Warren Buffett's time, because there's thousands of people like me and hopefully you combing around for explicit discounts like that. What a real value investor is, I think, is somebody who actually takes the approach that in any market, there can be, because of emotion, because of people overreacting, discounts in any kind of industry to what that company is ultimately worth based on its free cash flow, based on its return on capital. Um, and so the concept that technology stocks or growth pharmaceutical stocks are not values, has always mystified me, even way back in the year 2020 when we had the dot-com crash. The aftermath of that saw people like me buying software companies, many of my friends looking at growth pharmaceutical companies. Remember, at one point, Amazon was down 95% from its 2000 peak, and people were able to snap that up. Apple at one point was considered a broken growth stock back in the early 2000s, but indeed it was retrospectively a value if you were able to understand and make an assessment of future growth. One of the things that I encourage you to do is on growthier companies, on tech companies, on software companies, companies that spend a decent amount on R&D, research and development. Look at that on the income statement over time, because while they're expensing R&D at many of these companies, um, the concept is they're reinvesting in future growth. And if that R&D spend is manifesting itself in things like, well, we'll take an extreme example, the cloud that the Amazon Web Services that Jeff Bezos invested in years back, or the iPhone, which of course was a R&D expense for Apple years ago. People were dismissing lower earnings because they were spending so much on R&D, and they were forgetting the fact that this R&D spend could be capitalized and ultimately created products like the one that I'm recording on right now on an iPhone. Uh, anyway, I think that value will always come back. I think that often right now in markets where you're seeing Magnificent Seven or high growth companies get rewarded for their innovation, often gives you bargains in other areas of the market. And ultimately, the next 10 years really will be proof of that. Really, the next few years, I think, will be proof of that. But keep looking for bargains. That's what we do. Sometimes there are a lot of bargains out there. Sometimes the best thing is to sit in cash. But we'll continue to try to answer that specific question. And thanks for joining.